my view is that although the inflation figures may look better for the next few months, in the long run, I think the inflation figures and interest rates will exceed the peak we had in 1980-81, when the 10 years Treasury was yielding more than 15%. It peaked out at 15.84% on September 21st, 1981. I think we're going to exceed that.
Overall inflation has moderated meaningfully in recent months in the United States. The core PCE, which excludes food and energy, only increased by 0.2% in June, the slowest rate since September 2021. The headline PCE, which includes food and energy, also saw a 0.2% increase in June, the slowest rate since March 2021. Currently, the year-on-year headline inflation rate is around 3% in the United States. Marc Faber, founder of Gloom, Boom and Doom report, highlights that inflation may appear to improve in the coming months, but both inflation figures and interest rates will go higher than the highest point we saw in 1980-81. If inflation does go higher, as Faber predicts, it could lead to an increase in the demand for gold. This could drive up the price of gold, making it a more valuable investment. Marc also mentions that fiscal deficits, which lead to inflation, act as a tax on the overall system. The fiscal deficits of the late 1990s, under President Clinton, were the catalyst for the current situation. A fiscal deficit occurs when a government spends more money than it earns in income. In 2009, during President Barack Obama's administration, the deficit increased to over $1 trillion to finance government stimulus programs aimed at combating the Great Recession. While it was a record dollar amount, it was relatively small compared to the size of the economy, which was only 9.7%. In 2020, under President Donald Trump's administration, the deficit rose to $3.1 trillion for the entire fiscal year. Marc also agrees with the opinion of Blumenthal, who suggests that the U.S. may have to inflate its currency due to unfunded liabilities, which are obligations that the government has without having enough money to cover them. In light of this, the Fed raised interest rates by 0.25%, the highest level in more than 22 years. 2 more rate hikes were expected, but markets now predict no more hikes this year. The Fed will make decisions on interest rates based on the latest data. Marc believes Fed is willing to take action to prevent the stock market from dropping significantly, even if it means printing more money. Let's watch snippets from Marc Faber's interview, but before getting into the video, make sure to subscribe our channel and give this video a thumbs up. Thank you.
I think for the US, they could, of course, reduce spending and they could increase taxation. But the way the political system in Western democracies is set up is that whenever taxes go up, they go up on poor people and the middle class and the upper middle class, but the super rich, they always find ways to avoid taxation through all kinds of foundations and benefits and so forth and so on. So at the end, tax increases have a very negative impact on the economy because it hits the people that consume the most, in other words, the middle class and the lower classes. And so it's unfair. Spending cuts would be desirable, especially in the case of the US and of European countries, where transfer payments are huge. You understand? A country that has expenditures, it could spend money on infrastructure and productivity improving capital spending. But to take money out of the pocket of someone through fiscal deficits and transfer it to someone else is of no use, macroeconomically speaking. And the deficits, that I need to point out, is a tax, a fiscal deficit, and which then leads to inflation, inevitably is a tax on the system. And in my view, this gentleman, Mr. Blumenthal, he's absolutely right. The US will have to inflate also because of the unfunded liabilities. The catalyst has begun already for a long time. Fiscal deficits under Clinton and the booming stock market of the late 1990s, there was for a brief period of time, for 3 years, there were fiscal surpluses. Since then, it's all red ink. And as a result of that, the government debt goes up and more money printing is necessary to finance this mess. The Fed, like other government agencies and like other politicians and government officials, they are all lying. Lying. They never tell the truth. They tell the public what the public needs to hear, and their interest is, of course, to maintain the financial market at the high level. They don't want deflation in financial assets, and if they could, they would also prevent deflation in real assets like properties. But this is difficult to control. But basically, they can't afford the stock market to drop 50%, so they will print money. In real terms, in other words, inflation adjusted has gone down. In other words, the Fed and the government statistics report that GDP is going up, but my figures suggest that the standard of living of the typical household in the US and in Europe is going down.
On being asked about the yet-to-be-launched BRICS currency, Marc believes that many different currencies should be used for international trade, as this would help to spread power and reduce the risk of economic instability. China and Brazil have made an agreement to conduct their trade and financial transactions using their own currencies instead of the US dollar. China's yuan is becoming more influential globally. Argentina is the latest country to accept the yuan for transactions when importing goods from China, moving away from the US dollar. Similarly, Bangladesh, which is India's neighbor, has also decided to use the yuan to settle payment for a nuclear plant. Regarding the current dollar-dominated system, Marc believes that it should gradually phase out as economic power has shifted to emerging economies like China and India. He prefers a stable currency backed by gold and other precious metals, and would like to see a return to the gold standard. However, he doesn't think it's likely to happen soon. The New York Stock Exchange and Nasdaq are two of the largest stock exchanges in the world, and together, they represent a significant symbol of American financial power. Their combined market value is much bigger than any other stock exchange globally. As the dollar's dominance wanes, it's anticipated that investors will increasingly look to emerging markets like China and India for investment opportunities. This could lead to a more diversified global financial system, which could be beneficial for everyone. Marc recommends diversifying investments in other countries, including stocks, funds, commodities, and real estate, to take advantage of opportunities beyond the U.S. market. Let's watch Marc Faber's interview with Stansberry Research.
In my view, it is desirable for the world to have many participants in global economic affairs and in global politics. In other words, I think the system should not be a system where you have a kind of a currency, a global currency, like the dollar was, or before the British pound, or the Spanish peseta, and so forth. I think the best is that we have many different currencies and that people trade freely with each other. In other words, when China trades with Saudi Arabia, or China trades with Brazil, or China trades with Russia, there's no need the transaction should occur in US dollars. It should occur either in Saudi Real or or in Chinese yuan or RMBs. In other words, I think the best for the world is that the dollar system that prevailed is gradually phased out, and this is going to happen because the balance of economic power, which was strongly in the hands of the United States in the 1950s and 60s, since the 70s, and especially after the 1990s when China really began to open up, this balance of economic power has shifted into emerging economies. China is a much larger industrial producer than the US today. In 1970, China only consumed 2% of global industrial commodities. Today it's close to 50%. China produces more cement than the rest of the world combined. There's a big country, and another big country is coming up, India. It's now a larger economy than Britain, who were the colonial master of the Indians for years. It's a new world, but the American politicians, they can't accept the fact that the US is no longer the number one economic power in the world. It is still an important power, but it's not the number one power any longer. There are many number one powers, including China in some industries, India in other industries, Brazil in other industries, and. I mean, I'm in favor of gold and precious metals, and I'm in favor of a stable currency. I think money is far too important to leave it into the hands of some academics who've never worked in their life. They went to universities and write all kinds of paper that are entirely useless at taxpayers' expenses and so forth. But they shouldn't be in charge of essentially the budget of a country. So I'm in favor, of course, of a gold standard, but I don't think it will happen. Now, I think what investors should consider is that at the present time, the US is approximately or more than 50% of global stock market capitalization. And the US dollar is the unit of account globally. Most trade still happens in US dollars. I think over time this will change, and that investors should move money out of US dollars, but not only move out of US dollars and hold the funds in the US, they should actually invest in other countries, in stocks, bonds, commodities, and real estate.
Inflation is a hot topic right now, and there are a lot of different opinions on how to deal with it. What do you think about Marc Faber's views on inflation? Do you agree with him? Let us know in the comments below. That's all from us. If you like this video, please like, share, and subscribe to our channel and click the bell icon to be notified when we release new videos. Currently, 96% of you have not subscribed to our channel. Our goal is to reach 1,000 subscribers as soon as possible, and we cannot achieve this without your support. Please consider subscribing to our channel and helping us reach our target. Your support means a lot to us.